Good evening, I'm Cameron Roth, and I have chosen to do my capstone on American Airlines Group. And technical difficulty. There we go. Alright, so here we've got stock overview. I'd like to point out the drop after 2010. That was due to the bankruptcy and merger with US Airways. And then after it took off out of bankruptcy protection, the stock rose pretty rapidly. And then this drop off here after 2020 is COVID effects. Organization, so chairman of the board and the CEO is Doug Parker up there at the top. And then we've got these photos of his important players. Biggest thing over here is on the right hand side. They've got a huge network, both internationally and domestic. But in addition to their 6 primary airport hubs is the HQ, which is in Dallas-Fort Worth, which is where the company's headquartered. American here, the major line of business is air transport, but also they operate their hubs, and then they have regional carriers, their loyalty program, which is actually worth more than the company itself, and their international partners. Biggest competitors here, Delta is the closest competitor. They have a similar business model. United has a different business model while being similar sized, and then Southwest is a competitor in the domestic market but has a completely different business model. So here we stack up against Delta. Going down the thing, a lot of it's similar. A lot of them don't prescribe to conventional wisdom just because the airlines run pretty difficult margins. But if you look at operating margin and profit margin, so American is only running half of the operating margin of Delta and only about a third of the profit margin. So when you look at them as competitors, clearly Delta's doing some things right that America is not when you look at that operating and profit margin. Balance sheets, the only thing I'd call out here is on the income statement. The regional expenses here, $7.5 billion, quite a lot more than either Delta or United pay for their regional expenses. So either American is structured differently, or America drastically needs to bring those costs down by a third to half to be more competitive with their other 2 main peers. So, the immediate implications, American struggles with liquidity. Going into 2020 when COVID hit, which nobody expected, that's now been a problem for them. They had huge operating costs, and then when COVID hit and they weren't getting any revenue, those costs then turned into a problem. I mentioned here in the long term as well. So American's regional expenses were $4 billion higher than Delta's. So more than anything, as American works on getting rid of its debt load, increasing liquidity, it needs to work on bringing down costs so its margins look a lot better. Same thing here. All right, so my notes is that Delta had been trailing the S&P 500, so as an index, it was following along. American, though, has been on a trend that's been downhill, I think because of their high debt load, and so as they leverage themselves more and more and more, they're going to end up in a difficult situation. We talk here a little bit about the fact that American was paying a dividend and also doing stock buybacks. So some of their cash flow was not actually as bad as it looked because they were actually using that cash in their stock. Biggest risk for American, because they lease all their aircraft, as their position weakens, the interest rates on the aircraft go up. That just is a vicious cycle for them. and then now as they're trying to avoid Chapter 11 and keep their fixed costs covered during the COVID crisis, is that they are increasing debt through bond offerings. But then as the yields and the rates go up on those, once again, the worse off they are, the worse their interest rates get, and then that hurts them. This bond here was very interesting to me. There's only three payment cycles left on it because it matures in January of 2022. But it was a 5% bond, and at the current market rate discount of 75.75, that yield is estimated at 25%, which I thought was pretty good. Plus, since it's unlikely that American would completely go into Chapter 11 or be wiped out by the government protections before January 2022, that these bonds are probably a pretty safe investment right now because they're not likely to go very far. Their longer term bond, 3.75%, so the return is not as good as on this. And then because this is a 4-year maturity bond, without knowing what might happen in the COVID recovery, this actually could be risky because, in years 23, 24, 25, if American was to enter Chapter 11 or something, this bond could be affected in the long term. Stock valuation, very hard for this. Not dividend paying right now, and it has non-constant growth because obviously their business or their sector has been completely imploded. So the corporate valuation model we used here, but then once again, because their cash flow wasn't actually as bad last year as it looks, even though they were negative, it was because they were doing that almost $1.3 billion in stock buyback and dividend totals there. My recommendation on this is hold. It's likely that American, if it does recover, is going to raise their stock prices back up. They're probably not going to pay dividends for a while, but you can get that growth or at least recovery of your price that you held on the stock when you bought it. Buying, I would not advise buying right now because it is high risk. And I would not advise selling because it's already at the low end. Overall summary, as I said, is to hold. And if you don't have anything to do with American Airlines, that 5% bond could be something interesting to look at, trying to buy into that at the market rate with their discount. The only thing, it's more analysis than is included by just their financials. But because American was hit so hard with COVID, they tried to cut costs very early, which included retiring older aircraft and continuing keeping their new aircraft on the books. Delta, which had better books because they didn't have new aircraft because they didn't have a lot of that debt, is now going to be operating older planes. If American can stay on its feet, it's better poised moving forward because it's going to have newer, more efficient aircraft that use less fuel, which then increases margins. Plus, they're less likely to be down for maintenance and cause strife in the networking plan. So therefore, American could be, in a leverage sense, American could be much better poised to recover if the travel market recovers than either Delta or American. So overall, hold the stock, and if you can, invest in that bond. That's my recommendations. Thank you very much for viewing this. And again, I was Cameron Roth. Thank you.